Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Good morning, Will. How are you feeling after the game this weekend?
Little sore, little sore. So, I mean, those of you who are listening who don't know, so I went to the University of Missouri. That's where I did undergrad at, and Ben over there, he went a little bit further west to Manhattan. So, yeah.
Yeah, that's all right. I was having a little bit of an identity crisis on Saturday because the University of Missouri does pay my salary, and I do have a degree or two from the University of Missouri. So it was fun. I mean, I've been looking forward to this game for years, literally since it was announced. I'm so glad these two teams are playing each other, and I look forward to the rematch next year. So
Yeah, hopefully at least it's a game either way next year. It was not a game this year. It was pretty sad. But anyway,
also miserable. It rained the whole time.
but yeah. So anyway, looking at markets, what are we standing this week? What adjustments have we seen over the last week?
Yeah, so up pretty much, I mean, up across the board. New crop December corn up 31 cents to 6.96. November soybeans up 83 cents on the week to 14.88. That came after the big increase yesterday on Monday. Soybean oil was up almost 2 cents to 68.3 cents per pound. Soybean meal up 27.50 or $25.70 per short ton to 439. Old crop wheat for December of 22 up 44 cents to 8.58, and then new crop July 23 wheat up 34 cents to $8.75.
So what's really led into the support? What kind of factors have you seen the last week?
Yep. So U.S. weekly ethanol production last week was up 5.6 million gallons to 290.8 million gallons on the week. That utilized 98 million bushels of corn. Gasoline demand rebounded for the corresponding week, but still remains about 9% below seasonal levels. Again, this is our big demand season for gasoline, and that continues to remain below, due probably to higher gas prices experienced this summer. Export sales reports continued to be delayed on technical difficulties, although USDA expects to go back to regular reporting on Thursday, September 15th. Daily flash sales, however, have led us to believe that 10 million bushels of corn were sold to Mexico last week, and 3.8 million bushels of soybeans were sold to Taiwan. Open interest futures and options positions of Chicago wheat, corn, and soybeans were all slightly up. Managed money positions decreased 2,349 positions for Chicago wheat. They decreased 2,172 positions for soybeans, but increased a little over 5,000 positions for corn. Export inspections for the last week of the marketing year. So this is, export inspections are delayed a week. So for that last week of the old crop marketing year, export inspections were down for corn, beans, and grain sorghum, but up for wheat. Looking at that a little bit more closely, soybeans fell below all trade estimates, while wheat exceeded all trade estimates. 25% of the U.S. corn crop is rated mature, and 5% of it's been harvested. The national corn conditions rating was down 1% to good to excellent to 53%. The national soybean conditions rating also declined a percent to 56%, good to excellent. And then the September USDA supply and demand estimates that came out on Monday of this week were in line with trader expectations for U.S. corn yield. However, the U.S. soybean yield fell 1 bushel per acre on a national average, which fell below all trade estimates. As a result, soybean prices were up big on Monday.
All right, so a lot of moving factors there, and today we're talking about a big report that came out yesterday, the World Ag Supply and Demand estimates from USDA, and within that, two of the main pieces, maybe we saw production estimates for corn and soybeans go down domestically. What do you see there? Were those surprises, and B, how do you see that playing out longer term?
Yeah, so the big estimate was that drop in soybean production down almost a bushel and a half, 1.4 bushels per acre across the entire country. The expectation was that we would see a little bit of a pullback in soybeans and that soybean yield to go a bushel and a half. I think, well, it did. I mean, it's not, I think it did catch everybody off guard. Really reduced that soybean production number, pulling both production and then stocks down on the soybean side, which led to that big rise that we saw yesterday. So that was the biggest surprise. The other thing that I think caught people by surprise was USDA reduced harvested acres of corn, a million acres. That was to kind of cooperate with some of the early reports coming in through the Farm Service Agency. When we look at that new crop carryout that was anticipated by traders, they were anticipating a 1.2 billion bushel carryout, or a little over 1.2 billion bushel carryout. I mean, that's largely what we got. So even though we don't survey traders about what they think acreage is going to be, the fact that we were relatively close in terms of carryout. Now, keep in mind that's taking into account all the demand changes as well. Signals that the market largely had kind of figured out what corn was going to do. Some big changes. I mentioned demand destruction for a second. Some big changes up and down the demand sheet, and largely you get to these higher prices, these tighter stocks, these higher prices, and you start to see some limitations and limiting demand there. So I certainly think that's coming into play.
So we're sitting here in mid-September, and we've hit the very early part of the harvest season, just extremely early still. But how much wiggle room is left within these numbers? I mean, how much of an adjustment could we see before we get the U.S. crops out?
Yeah, so I tend to use, as a rule of thumb, 8.5% stocks to use ratio as a threshold for demand rationing on corn. And if you calculate our ending stocks to anticipated use for the new crop marketing year, it comes out to 8.5%. That's not, I mean, like I always have used 8.5%. So it's not, I'm using that just for this report because that's what it happens to be. So to answer your question, I think we're very tight, and especially on feed grains. This is the tightest we've been in years, decade plus, in global and US wheat supplies. And this is a very tight picture on the corn side as well. So when we look at the feed grain side of this equation, we're very tight. Now, the soybean numbers certainly make the soybean balance sheet tighter as well. And I think that's what maybe the market was reacting to. I mean, that was what the market was reacting to yesterday. A big jump up in soybeans, which then kind of pulled corn up a little bit. Had we not had the big surprise in soybeans, I think corn would have been flat to maybe even slightly down yesterday, because we've banked in a lot of this premium, and I think for the corn picture, we've got a lot of this shortfall built in. It's just a matter of, okay, are we not going to see as much demand destruction as what we think, and we start seeing more exports even in the face of higher prices and tight supply? Do we see feeding levels stay elevated? Those are things that could really tighten this pretty quickly, is if the demand side of the equation stays elevated for a longer period of time than what we anticipate.
So looking at the market pressures you're talking about and seeing, the tightness, especially within corn and wheat, but also growing tightness within soybeans, like you said, how do you expect the market to maybe operate as we go through harvest season? Because historically, you start to see those prices maybe, fall back down during harvest. That wasn't necessarily the case, the last two seasons for the whole time. So how do you see this year playing out compared to recent history and what would be the norm?
Yeah, so there's one big factor here that always concerns me when I sit here and look at these tight markets in the US, and people are thinking, hey, we could bulk this trend where we have prices that continue to rise all through the winter into the spring. There's one thing that really kind of scares me, and that's our South American partners. The reason that, in fact, it concerns me more than if the scenario was flipped. And the reason is this whole concept of peak acreage here in the United States. I don't know where we're going to come up with additional acres. We had we had high prices, and we had government programs that were coming out to encourage planting and production this year, and we still decreased acres. So that's our situation here. However, it's very different in South America. And certainly the expectation is to see South America not only increase acreage due to these high prices and the signal their producers are getting, but also at this point, we have to believe that they're going to have better yields than what they've had the last 2 years. They've had 2 years of yield shortfalls due to differing things. But we could see a very large crop out of South America that, given our tightness here in the United States, a lot of the export market moves to South America. So that's my big risk factor, to sit here and say, like, hey, yeah, there's a lot of positives on the supply shortfall here in the United States for prices to go higher. Or I guess if you're a livestock producer, that's a negative for prices to go higher. But I look out to South America and I say, there's quite a big chance that they could actually come in and supply the world market until we get ready for harvest next year. So I'm not ready to say. That's my long-winded roundabout way of saying I'm not ready to say that these prices will stay high all through the spring. They're certainly high now. They're going to stay high for the next couple of months until somebody has a harvest, that being South America in February and March. But that's a big determination in terms of how long these are we going to see higher prices stay till November, December, or are we going to see them stay high all the way through April and May? I mean, I think that's the question.
Well, it's pretty interesting. Sorry to cut you off, but it seems like the last couple of years, South American production, they're like a slugger who keeps swinging for the fence. They keep fouling the ball off, but eventually they're going to run into one, and you're going to see a lot of price decrease, domestically, just because they're going to take up a lot of those export market bids.
Yeah, no, I agree. And for fairness, for those of us, or for those listeners out there, in fairness, I said this exact same thing a year ago, right? Like there was low probability that South America was going to have another year of supply shortfalls, right? Like that's just, you can't, if you have a drought, the likelihood of having a drought another year is low. Well, they did. They had another drought. And so now I'm sitting here and I'm like, okay, can we follow that up again? Right? Like the probability of that happening a third time is rather low. So, I said this last year. I'm saying it again this year. Like, but the flip side of that, Will, is like, and this is probably more for our livestock audience, and especially those that are end users of corn. We are now tight enough in the U.S. Keep in mind, last year we had very good production in the United States, and we still had some supply tightness, even with very good production. This year, having a weak, having a supply shortfall, if South America were to have another challenging year, our prices are going to go a lot higher to ration demand. I mean, that's where we're at. Is like this is kind of we could be sitting on a return to, let's just say, $4.55 corn with a good South American crop, or a bad South American crop takes us up closer to $10. Like that's where we're sitting, and that's kind of scary when you're thinking about somebody out there trying to manage risk, trying to manage cash flow of an operation. So.
Yeah, well, especially, coming into a year to where maybe, haying is at a premium just because of a lot of droughts that we've seen, stretch from, Missouri down into Texas and even west. So it's definitely going to become a pinch there, you'd imagine. Looking ahead, go ahead. I'm sorry.
Nope, I agree fully. I mean, our poor livestock producers, especially those that are cow-calf producers that need hay and grain, it is a challenging environment for them.
So looking ahead, are there any, I guess, further reports coming out this week that producers should really be paying attention to?
Yeah, so Wednesday, we get the U.S. ethanol and energy market report. That's kind of our signal for our gasoline consumption and demand. So that comes out Wednesday at 9:30 a.m. Thursday, export sales will start back up. So that's exciting that those are going to start back up. We also get the National Oilseed Processors report for the month of August on Thursday at 11 a.m. Central Time. And then Friday, that Commodity Futures Trading Commission traders data report at 3 o'clock Friday afternoon.
I always get excited when you talk about NOPA reports,
I do too. It's a fun word to say as well. That makes me sound, amateurish, but it is a fun word to say. Good job. Good branding.
All right. Well, if listeners would like to check out more of our content, you can do so at brownfieldagnews.com. Also, check out our counterparts on the livestock side. Kind of dabbled in that area today, but that's Megan Grebner with Brownfield and Scott Brown with the University of Missouri. Thanks for joining us this morning, Ben. It's always a pleasure. I'm Will Robinson on Brownfield.